Today, I'm going to show you the most popular tax deductions that LLC owners actually use. This comes from real IRS data. We'll look at what the majority of successful LLC owners are writing off, and I'll explain exactly how you can use these same strategies. By the end of this video, you'll know which deductions matter most. You'll understand how to claim them properly, and you'll have a clear action plan to lower your tax bill starting right now. Let's dive in. Chapter 1. Understanding your LLC tax structure. Before we talk about specific write-offs, you need to understand something important. Your LLC doesn't pay taxes the way you think it does. The IRS doesn't see your LLC as a separate tax entity. Instead, your profits and losses pass through to your personal tax return. This is called pass-through taxation. But here's where it gets interesting. How your LLC gets taxed depends on how many owners you have, and this completely changes which deductions you can claim. If you're the only owner, you're called a single member LLC. The IRS treats you like a sole proprietor. All your business income and expenses go on Schedule C of your personal tax return. If you have business partners, you're a multi-member LLC. The IRS treats you like a partnership. Your business files Form 1065. Then each partner gets a K-1 form showing their share of profits and losses. There's also a third option that many LLC owners don't know about. You can elect to be taxed as an S corporation. This requires filing Form 2553 with the IRS, but it can save you thousands in self-employment taxes if you make enough profit. The deductions you can claim are different for each of these structures. That's why we're going to look at all three. Most YouTube videos about LLC deductions get this wrong. They give you a generic list that might not even apply to your situation. Now that you understand the foundation, let's look at the actual data on what LLC owners are writing off. Chapter 2. The top write-offs for single-member LLCs. But really quick before I move on, if we haven't met yet, I'm Sean's clone, a licensed tax professional who personally researches and writes every script you see from me. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you need help with tax planning, click the link below to get a free consultation to start saving more money before the tax year ends. All right, now Chapter 2, the top write-offs for single-member LLCs. Single-member LLCs are the most common type of LLC in America. If this is you, these are the deductions your peers are using most. The number one write-off is vehicle expenses. Nearly 1/3 of all single-member LLCs claim this deduction. The average deduction is almost $10,000 per year. You have two ways to calculate vehicle expenses. The standard mileage rate is simpler. For 2025, you multiply your business miles by 70 cents per mile. If you drive 10,000 business miles, that's a $7,000 deduction. The actual expense method can give you a bigger deduction. You track all your car costs, gas, oil, repairs, insurance, registration fees. Then you multiply by the percentage you use the car for business. Either way, you must keep a detailed mileage log. Write down the date, miles driven, where you went, and why it was for business. Do this every time you drive for business. The IRS requires this documentation. The second most popular deduction is supplies. Over 22% of single-member LLCs claim this. It includes everything from office supplies to software subscriptions. The average deduction is over $7,000. Here's a tip that saves many business owners money. If you buy something that costs $2,500 or less, you can deduct the full cost right away. You don't have to spread it out over several years. This covers most computers, printers, and office furniture. Office expenses come in third. This includes things like accounting software, cloud storage, and payment processing fees. About 16% of single-member LLCs claim this deduction. Taxes and licenses rank fourth. This might surprise you because not as many people claim it. Only about 18% of filers. But the average deduction is over $10,000. This includes business licenses, permits, and the employer's share of payroll taxes if you have employees. Utilities round out the top 5. This covers electricity, internet, phone service for your business. If you work from a commercial space, these are fully deductible. If you work from home, these get calculated as part of your home office deduction. Speaking of working from home, many single member LLC owners miss some of their biggest deductions. These don't go on Schedule C, they go on other parts of your tax return, but they're just as valuable. You can deduct half of your self-employment tax. This acknowledges that employers normally pay half of their workers' payroll taxes. As a business owner, you're both the employer and employee. If you pay for your own health insurance, those premiums are usually 100% deductible. This includes medical, dental, and long-term care insurance for you, your spouse, and your kids. Retirement contributions are another huge deduction. You can contribute up to $70,000 to a SEP IRA or solo 401k in 2025. This reduces your current taxes while building wealth for the future. These deductions paint a clear picture. Most single-member LLCs are solo operations. They work from home or travel to clients. They don't have employees or commercial rent. If your business is growing beyond this model, it might be time to consider other tax structures. Chapter 3. Multi-member LLC deductions that drive real savings. Multi-member LLCs operate at a completely different scale. The IRS data shows these businesses have more complex operations and bigger deductions. The most claimed deduction is still the catch-all category called other deductions. Over 83% of multi-member LLCs use this. It averages over $400,000 per business. This includes advertising, professional services, travel, and utilities that don't fit other categories. But look at the specific deductions and you'll see the difference. Taxes and licenses are claimed by almost 72% of multi-member LLCs. The average deduction is nearly $118,000. This shows these businesses own more property and have more employees than single-member LLCs. Interest deductions tell an important story. Over 40% of multi-member LLCs claim this. They deduct over $300 billion total. This shows these businesses use debt financing to grow. They take out loans to buy equipment, real estate, and fund operations. For 2025, there's good news about interest deductions. The new tax law makes it easier for businesses to deduct more of their interest expenses. The rules for the business interest limitation have been relaxed permanently. Salaries and wages are a major expense for multi-member LLCs. Over 26% pay employees. The total deduction is over $700 billion. This shows many of these businesses have formal payrolls. Guaranteed payments to partners are unique to the structure. About 18% of multi-member LLCs use this. It's like paying a salary to the business owners. The average is over $200,000 per business. Rent is another big deduction. About 25% of multi-member LLCs pay rent for business space. The average deduction is over $140,000. This confirms these businesses operate from commercial locations, not home offices. The pattern is clear. Multi-member LLCs are established businesses. They have employees, commercial space, and use financing to grow. This creates more deduction opportunities, but also more complexity. If you're running a multi-member LLC, make sure you're taking advantage of all available deductions. The amounts can be substantial, but the rules are more complex than single-member LLCs. Chapter 4, S Corporation Election, the game-changing strategy. Some LLC owners make a strategic choice that can save thousands in taxes. They elect to be taxed as an S corporation. This changes everything about their deductions and tax strategy. When you make this election, you become an employee of your own business. You must pay yourself a reasonable salary. This salary is subject to payroll taxes, but any additional profit can be taken as distributions, which avoid self-employment taxes. The IRS data shows how powerful this strategy is. Almost 60% of S corporations pay officer compensation. The total amount is over $570 billion. This represents the reasonable salaries that business owners pay themselves. Regular employee wages are even bigger. Over 40% of S corporations have other employees. The total wage deduction is over $600 billion. This shows that S corporation structure is popular with established businesses that have staff. Here's how the tax savings work. Let's say your LLC makes $200,000 in profit. As a regular LLC, you'd pay self-employment tax on almost the entire amount. That's over 15% in self-employment taxes alone. With an S corporation election, you might pay yourself $80,000 as a reasonable salary. You pay payroll taxes on that amount. The remaining $120,000 comes to you as a distribution. No self-employment taxes on that portion. This strategy becomes profitable when your business makes around $80,000 or more per year. Below that amount, the additional costs and complexity usually aren't worth it. But if you want to learn more about the potential savings for you, click the link below. There's another benefit many people miss. The S corporation election can help with the qualified business income deduction. This lets you deduct up to 20% of your business income. But if you make too much money, the deduction gets limited by your W-2 wages. As a regular LLC owner with no employees, you have zero W-2 wages. This can eliminate your QBI deduction entirely. When you elect S corporation status, your reasonable salary counts as W-2 wages. This can unlock a much larger qualified business income deduction. The S corporation structure requires running payroll and filing a separate tax return. These create additional costs and complexity, but for profitable businesses, the tax savings usually far exceed these costs. If your LLC is making substantial profits, you should analyze whether the S corporation election makes sense. The potential savings can be significant, but the decision requires careful planning. Chapter 5. Major deduction categories you need to know. Now let's dive deeper into the deduction categories that can make the biggest impact on your tax bill. These work across all LLC structures, but the rules and limits can vary. Asset-based deductions are some of the most powerful tools available. When you buy equipment, vehicles, or other business property, you don't have to spread the cost over many years. Thanks to recent tax law changes, you can often deduct the entire cost immediately. Section 179 expensing lets you deduct up to $2.5 million of equipment purchases in 2025. This is a major increase from previous years. The phase-out threshold is now $4 million, meaning larger businesses can still benefit. Bonus depreciation is even more generous. You can deduct 100% of qualifying property in the first year. This includes new and used equipment, vehicles, and machinery. The 2025 tax law made this permanent, giving you long-term planning certainty. Let's say you buy a $100,000 piece of equipment for your business. Under the new rules, you can deduct the entire $100,000 in the year you buy it. This immediately reduces your taxable income and your tax bill. The home office deduction is crucial for many LLC owners. To qualify, you must use part of your home regularly and exclusively for business. This could be a dedicated office or even a corner of a room, as long as it's only used for business. You have two ways to calculate this deduction. The simplified method gives you $5 per square foot up to 300 square feet. That's a maximum deduction of $1,500. It's easy to calculate, but often leaves money on the table. The regular method is more work, but usually gives a bigger deduction. You calculate what percentage of your home is used for business. Then you deduct that percentage of your home expenses. Mortgage interest, property taxes, insurance, utilities, repairs. You can also depreciate the business portion of your home. Personnel-related deductions become important as your business grows. Salaries and wages paid to employees are fully deductible. This includes both W-2 employees and payments to independent contractors. Employee benefits are also deductible. Health insurance premiums, retirement plan contributions, and other fringe benefits. These deductions help you attract and retain good employees while reducing your tax bill. For business owners, establishing a retirement plan is one of the best tax strategies available. Plans like SEP IRAs and 401ks allow huge deductible contributions, up to $70,000 in 2025 for high-income earners. The key with all these deductions is proper documentation. The IRS requires detailed records to support your claims. Keep receipts, invoices, contracts, and detailed logs for expenses like vehicle use and business meals. Good record keeping isn't just about compliance. It helps you identify deduction opportunities you might otherwise miss. Many business owners leave thousands of dollars in deductions on the table simply because they don't track their expenses properly. Chapter 6, 2025 Tax Law Changes That Benefit LLCs. The 2025 tax law brought several important changes that benefit LLC owners. These aren't temporary provisions that will expire. They're permanent changes that you can plan around for years to come. The qualified business income deduction is now permanent. This 20% deduction for pass-through businesses was set to expire at the end of 2025. The new law makes it a permanent feature of the tax code. The income thresholds where the QBI deduction starts to phase out have also been increased. More high-income taxpayers can now claim the full 20% deduction before limitations kick in. There's also a new minimum QBI deduction. Starting in 2026, taxpayers with at least $1,000 in qualified business income will get a minimum $400 deduction. This ensures even very small businesses get some benefit. Bonus depreciation is back to 100% permanently. This provision had been scheduled to phase down, dropping to 60% for 2024. The new law restores full first-year expensing for qualified property and makes it permanent. Section 179 limits have been increased significantly. The maximum deduction is now $2.5 million, up from previous limits. The phase-out threshold is $4 million. This allows much larger businesses to take advantage of immediate expensing. The business interest expense limitation has been relaxed. Businesses can now add back depreciation when calculating their limit. This allows companies to deduct more of their interest expenses, particularly important for businesses that use debt financing. These changes create significant opportunities for tax planning. The permanence means you can develop long-term strategies without worrying about provisions expiring. For capital-intensive businesses, the enhanced depreciation rules are game-changing. You can now plan major equipment purchases knowing you can deduct the full cost immediately. The permanent QBI deduction solidifies the tax advantage of pass-through entities like LLCs. Combined with the enhanced depreciation rules, it makes the LLC structure even more attractive for many businesses. If you haven't reviewed your tax strategy recently, these changes make it worth taking another look. The new rules might open up planning opportunities that weren't available before. Chapter 7. Your action plan for tax success. Here is your immediate action plan to maximize LLC tax deductions. First, identify your current tax structure. Know whether you file Schedule C, Form 1065, or have elected S corporation status. This determines your available deductions. Second, evaluate if your structure fits your profit level. Single-member LLCs making over $80,000 should analyze S corporation election for self-employment tax savings. Third, start proper record keeping today. Separate business and personal expenses completely. Track everything in real time. Keep detailed logs for vehicles and home office use. Fourth, plan equipment purchases strategically. The permanent bonus depreciation rules let you deduct full costs immediately. Time purchases based on your business needs and cash flow. Finally, consult a qualified tax professional. These strategies can save thousands, but proper implementation requires expert guidance. Click the link below if you want some extra help. Remember, successful tax planning happens year-round, not just at tax time. Master your deductions, maintain excellent records, and make informed decisions. Your future self will thank you for the tax savings and business growth that follows. The bottom line is this. These are some of the most popular tax write-offs for LLC owners, but you should always seek tax deductions that are best for your business. Writing things off just for the sake of it is never a good idea. If you're unsure how to position your LLC, click the link below to get expert help. Tax write-offs are great, but sometimes investments can be even better. Coming up next, I have a video on 10 new investments that can reduce your taxes instantly. So check that out next. As always, thanks for watching, and I'll see you in the next video.